Hello everyone, I am Hemant Kanawala and I manage equities at Kotak Life Insurance. I will like to share some of the key highlights of the budget for the year 2021-22. As you are aware, last year was a challenging one due to pandemic crisis. The government increases expenditure by 28% to 35 lakh crores to support lives and livelihood. Nominal GDP degrew by 4% and fiscal deficit increased to 9.5%. General expectation from the budget was there will be increase in tax liability and government will continue with its fiscal conservatism. Deviating from this predictable route, the budget marks a definite change in the government's policy approach as it begins to shift gears towards enhancing long-term growth potential through a mix of reforms and aggressive capital allocation. Finance Minister has proposed a fiscal deficit of 6.8% for the year 2021-22 and provided a glide path to bring it down to 4.5% by FY26. This will give government an additional room to provide fiscal stimulus in the coming years to support the economy. Two key highlights of the budget are big thrust on physical infrastructure and continuous momentum on reforms. Although the overall expenditure has remained flat, the government has increased allocation to capital expenditure by 26% to 5.54 lakh crores. This is on the back of 30% increase in FY21 also. The main area of spending remains rail, road and Jal Jeevan Mission. This is expected to create employment in the short term and increase the competitiveness of Indian manufacturing industry in the long term. To fund this, government has announced setting up of development financial institution with a corpus of 20,000 crores. And this institution is expected to disburse around 5 lakh crores over the next 3 years. The other area has been continuous commitment to reforms. The government has confirmed that it plans to divest some of the public sector enterprises like BPCL, Concord and BML in the fiscal year 22. It has also additionally announced listing of Life Insurance Corporation of India and also divest 2 PSU banks and 1 general insurance companies during the year. Asset Reconstruction and Management Company has been proposed to buy stress assets from PSU banks. This will help in strengthening the balance sheets of PSU banks, which can provide credit to the economy. FDI in insurance has been increased to 74%, which will help bring foreign players in the insurance sector. Overall, the bias of the budget has been to promote domestic economy, which will benefit sectors like banking, cement, construction, and other domestic sectors. But the market was estimating earnings growth of 30% for FY22 and another 20% for FY23, which looks possible post the stimulus given by the government. Now I will hand it over to Churchill Butt to share his views on the debt market post-budget.
They say never waste a good crisis. And FY22 budget sure didn't waste one. Hi, I'm Churchill Butt, Debt Fund Manager at Kotak Life Insurance. There's a clear change in mindset of the government when it comes to FY22 budget, where they're focused on expenditure-led growth. But if the government is going to spend more and not tinker with taxes and hence not increase its income, then the burden of financing the expenditure falls squarely on the shoulders of market borrowing. And that's exactly the case with FY22 budget. To put things in perspective, if we go back to pre-pandemic era, the dated market borrowing of the central government used to be in the ballpark range of 4 to 4.5 lakh crores, which in FY22 budget is upwards of 9 lakh crores, slightly more than double. There's also going to be an increase in the state government's borrowing as well. Coupled with the fact that the increased borrowing is largely to finance expenditure, which will in turn add to inflationary pressures in the economy, both the extra borrowing as well as the additional inflationary pressures due to spending will put an upward pressure on yields in the economy. To balance that, we may have the Reserve Bank of India stepping in to contain any sharp volatility in yields like we have seen them do in FY21 as well. In addition to that, we also believe that some of the assumptions in budget FY22 by the government are a bit on the conservative side, especially when it comes to the revenue side, both tax and non-tax, as well as when it comes to the nominal GDP side. So there's a very good likelihood that a year from now, when the actual fiscal deficit numbers for FY22 are out, we may be below the budgeted number of 6.8%. And lastly, India has been working towards getting included in the global bond indices as well. If we succeed in doing the same, then there is a very good chance that we will generate the additional demand by the foreign investors who will buy Government of India bonds due to the index inclusion to counterbalance the additional supply in FY22. To conclude, it's a great budget for growth, but there remains caution on the interest rates and fixed income side. We are likely to see yields inching higher and yield curves are likely to remain steep going into FY22. It's going to be a delicate balance for RBI in supporting the growth as well as managing the yields. It's going to be a good year for equities and a challenging year for fixed income. Thank you.